All right, let's get into it. Today, we're breaking down the second quarter 2025 earnings for ServisFirst bank shares, ticker SFBS. And you're going to want to stick around for this one because the market's reaction to their report was, well, pretty fascinating. We're going to figure out exactly why. Okay, so here's the central puzzle, the big question we need to answer. On the surface, the numbers look kind of weird. Their adjusted earnings per share, or EPS, came in right on the money, exactly what analysts were predicting. But, and this is a big but, their revenue missed the mark by almost 6%. Now, 9 times out of 10, a revenue miss like that would send a stock tumbling, but that is absolutely not what happened here. The very next day, the stock actually closed up over 1%, and on pretty heavy volume, too. So what gives? Clearly, the market decided to look right past that revenue number and found something else, something it really, really liked. So the question is, what was it? Let's just put these headline numbers up again so you can see what created all that initial confusion. The adjusted EPS, $1.21, a perfect match with consensus, but that revenue at $132.1 million, it fell way short of the $140.3 million Wall Street was looking for. You see these conflicting signals? It meant any serious investor had to dig a little deeper to find the real story. And this is what they found. The beautiful upward trend in net interest margin, or NIM. For any bank, NIM is an absolutely critical measure of profitability. It's the spread between what they earn on loans and what they have to pay out on deposits. And just look at this climb. It goes from 2.79% a year ago up to 2.92% last quarter, and now a really strong 3.10% in Q2. This margin expansion was the real story, and it just completely blew that revenue miss out of the water. So how'd they pull this off? Well, it wasn't just luck. It was a series of really smart, deliberate moves by the management team. Let's peel back the layers and break down the key drivers behind that awesome margin performance. First up, management decided to take a little short-term pain for a massive long-term gain. They sold off $70 million worth of these old, low-yielding bonds. They were only making about 1.34%, and they took an $8.6 million loss on the chin to get it done. But here's the genius part. They immediately turned around, took the cash, and bought new assets yielding a whopping 6.28%. This one move is going to supercharge their interest income for quarters to come. And hey, don't just take my word for it. The bank's own CFO, David Spracio, basically said so himself on the earnings call. He framed the whole thing as a strategic move to set the company up for better profits down the road. So the market didn't see a loss, it saw a smart, forward-thinking investment in their future. Now, in the interest of full disclosure, management was also really upfront about another item that helped the numbers this quarter. They had a one-time benefit, a $2.3 million reversal from a legal issue that got resolved. This made their deposit costs look about 7 basis points. That's 0.07% cheaper than they really were. Now, smart investors probably adjusted for this in their models, but they also appreciated that the underlying trend was still great, and they definitely appreciated the company's honesty. Now let's take a quick look at the balance sheet. Loan growth was really solid, up $346 million, but you might notice the deposits actually went down by $567 million. At first glance, that might seem like a red flag, right? But it was actually another deliberate, strategic choice. Management intentionally let some of their more expensive deposits walk out the door. Why? To improve their funding mix and, you guessed it, push that net interest margin even higher. Okay, so with that fantastic operational performance as our backdrop, let's shift gears and look ahead. What are the key factors, the catalysts that could drive the stock even higher from here? And, just as important, what are the risks investors need to keep on their radar? And this chart just says it all, doesn't it? It shows you exactly why the market is so bullish on these guys. Over the last 3 months, ServisFirst stock has jumped almost 21%. That's not just good, it's absolutely crushing its peers. It blew past the Regional Bank ETF, CRE, and it left the broader Financial Sector ETF, XLF, totally in the dust. This is the kind of outperformance that shows investors are rewarding top-notch execution. So looking forward, the bull case is pretty clear. Management is guiding for that net interest margin to keep on climbing, and they're targeting a range of 3.20 to 3.25% by the end of the year. They're also looking for growth from other fee-based businesses, plus, of course, the full earnings power from that bond portfolio restructuring we talked about. Now, on the risk side of the ledger, the main things to watch are deposit competition heating up, any unexpected problems in their loan portfolio, and these ongoing headwinds from commercial real estate loans getting paid off early. All right, time to put it all together. What's our final take? What are we going to be looking for in a next quarter, and how would we think about positioning for it? This is what we call the next call. So, based on their proven ability to actively manage and grow their net interest margin, plus their tight grip on costs and their proactive strategy, we're initiating coverage with an outperform rating. This company is simply executing at a very high level in what's still a pretty tricky environment, and we expect that to continue. Now for a trade idea. We're suggesting a pair trade. The idea is to go long on ServisFirst stock, while at the same time shorting a regional bank ETF that has a ton of exposure to commercial real estate. The thinking here is simple. This trade is designed to capture ServisFirst's specific strengths, what we call operational alpha, in managing its margin and growing its business lending. Meanwhile, by shorting that CRE-heavy ETF, you hedge against one of the biggest risks hanging over the entire sector. It lets you isolate and hopefully profit from SFBS's continued outperformance. This is not financial advice.